Okay guys, we're going back to the Answers Hub, and if you're unaware of what the Answers Hub is, it's part of the Scruffy squad in Discord. And what I do is I just look every day to see if there's a question. If there is, I'll come to the camera and I'll answer it. Now some of them are going to be public, a little bit like today's, but most of them are going to be just for the Rogue Squadron because they asked to get into it, and it's obviously just for them. So let's flick it over and we'll see. So kind of a good example. Wanted to understand what swap and change of sentiment meant. Good example. Would be great. Blah, blah, blah. There we are. Went in, did a full example for them. Now, what we have here is a question from Michael. So a little salute to you, Mike. Keep them coming. Nearly all candles retrace, correct? But everyone states wait for the break of a candle to enter. Would it be better to wait for the retracement of candle, say on an hourly, so we'll look at an hourly time frame, and then take the break of the candle? And is it a good idea to place the pending order at the top bottom of the wick plus spread? And is it a good idea? That's the same thing. Right, so I'll answer that quickly without actually going into chart. I will go into chart, by the way. Yes. If you're going to use the break of a candle, include the spread and use the extreme. So that is the wick, whether it's break a top, break the bottom. Same as if you're using levels. Allow the spread, because then that allows the market to travel. You know, because there's nothing worse than having an air kiss where it comes up, you've put your target there, but it doesn't quite push through for the spread, and it doesn't hit your TP. Likewise, when you're going into the market, you want it to show its hand and it's going in the direction you want, and not just come to the very top, test it, drag you in because of spread, and then pull away. Okay, so let me just open up a chart and we'll kind of talk through it a little bit more. Now, when you're talking about candles retrace, you are right. Down comes up. Down, went down, retraced a little bit. But in this instance, it didn't retrace fully into it because that just kept on going. Okay. This creates sort of areas of interest where you have what's called overextended candles. So that's an overextended candle, symbolizing that there will be some kind of retracement on the horizon. How do you know that? Because it's exhaustion. There's multiple sort of, in this case, selling. Now, there is the argument of saying there's only sellers there, and I've heard this said about other programs. That's wrong. This Forex trading is what's called sum zero. It's a zero-sum game. For every seller, there has to be a buyer, and every buyer, there must be a seller. There is never a singularity. It can't be done. You know, somebody has to purchase the product, whether that's made by the market maker or another person. Now, a market maker will always have somebody else on the other side of the trade. It's just the way it works. All it means is it's excessive selling. People are selling. And the retracement is basically people on the other side of the trade stops being hit and profit taking, forcing the retracement. That's all that is. So don't read too much into it. Now, if you are going to enter a market like this, there's a simple process. You can stay on the time frame. So in this case, if we look, there is a huge extended candle. This is actually what's called, it's like a flush out candle. In other words, buy, 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 buy. Huge candle, flushes everything out. Everybody's trapped, and then the market will sell off. Okay, it's also a catalyst from a news event as well. Now, these news events, as you can see, there's a one coming in right now. Again, you can use a retracement, but if you're working on the dominant direction, so in other words, you've got your direction in place, you can work it out. So I said you can maybe step down a Q. Well, you can look at this and you can go, right, okay, we'll take this candle just as case in point. So let me draw a line on it because I want to do something for you. So you've got two choices. If you were, say, you were going to buy this market, but as you can see, it's moved down, and your candle was, or your order point was above it plus the spread, as you said, because you wanted really to turn around and come pick the order up. Well, it never did. It fell away. So you're not at the mercy of the market. Now, likewise, you might think you're a seller and you can put your order there. And again, this is great for set and forget. Now, if you're set and forgetting, stay on the hourly chart, because you can just put your order under there. Next one comes, picks it up, and then you target down into said level. Takes it a few hours to get there. Job's done. Dead simple. But what if you're watching the market and you want to time it? Well, then this is where your question kind of comes into it. Take it down into a lower time frame. Let me just step this back a second. I want to make certain I've got the right candle. So that's 6 o'clock. So if you step it down one, -1, and we're looking for 6 o'clock candle, which would be there. So if that started at 6, that means it ends at 7. So this would be the end candle. Okay. That's the one that you look at. Okay. Your 15-minute. Now what you can do with that now is you place your order underneath that 15-minute candle. This one will come pick it up and then run back down. Now, why is that important? Well, let's just think that you're trading with these candles here and you've seen this green one. It's not a very good example, actually. This is a better example. Let me kind of highlight what we're looking at. So you're going short. We'll just say this is the end of the hourly candle. And there it is there. So that's the end of the hourly candle on this particular run. You would have your order point. I'll just put a smaller one in so I can manipulate it. You have your order point underneath the closing candle of the 15-minute. Right. It has to go down to take that in, but it didn't. It moved away. So what you can do is you can follow the candles up. So you follow in the opposite direction of the way you want to go. So if you're going short, you follow the green candles. So candle closed, you put your order under there. Has to come down. You've now automatically got a better price. This one closed under there, plus the spread, so this one doesn't take you in. Again, moved up ever so slightly. Moved up ever so slightly. But now, when these three come, you don't move it. And this is the candle that takes you in. And okay, this one rattled away, but then down it came. I was just using it as an example to show you how trailing works. Case in point, this might be highlighted a bit better because there is some thickos out there that'll be going, oh, well, it ran away from you. I haven't analysed the direction. I'm just giving a general view. So again, yeah, that would be the end of the candle. So it's under there. Up, pull it under, wait for it to close. That's red, so it stays where it is. That one closed green, pull that up, under there. These are red, you wait. This takes you in, hardly goes anywhere, and then runs down into a decent profit. So trailing your candles is important. And what we're getting at from this point is you've started here. You've analysed this. You've got your directional bias from here. And you've also identified the closing candle. Then all you need to do is just look at the candles underneath it and follow them. Now that saves you putting in a retracement and sort of waiting for the retracement. That's if you're watching and monitoring. Now, if you are to sort of run the trade and leave it, just put the order under there and let the gods play it out. Because if you put it halfway in, who's to say that it's not going to trace and keep on going on the retracement? We don't know. It's a safer way of doing it. So if you're set and forgetting, end of the hourly candle, let the trade come into you, set your next stall point or wherever you're targeting. Forget about it. If you're monitoring, go -1 down a time frame and then follow the candles till it takes you in. Simple way of doing it. Now, that works on anything. So if you're 4 hours is your monitoring chart, drop it down to the hourly. If you're 15 minutes, drop it down to 5. If you're 5 minutes, drop it down to 1. Daily down to 4, etc. Because what you're doing then is you're trading from the DNA of the candle. And the DNA of the candle will tell you what's going on. So I hope that kind of helps in a strange way. We'll keep exploring these. We'll certainly explore it in the Zoom call, bring it up in the Zoom calls. We'll look at it on a live chart in the moment. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.